So my name is Michael Carpentier, and I'm with Vista Equity, and we are tokenizing residential real estate. Oh, there we go. So I'd like to start off with this example. Imagine if you had $350,000, you'd saved up all your life, you really like cash, and you needed to use it. However, your financial institution said you can't, that you had to actually go out and get a loan and borrow against it. So even though you have all that cash, you wouldn't be able to use it. Plus, you'd have to spend 20 years to pay it off. It sounds, whoops, what happened there? Oh, okay. Sorry about that. It sounds implausible, but Americans do this every year. $2.53 trillion in home loans are accessed annually. There's total home debt of $11.7 trillion. Interest on an average home equals about $163,000 over 20 years. That's almost half the price of the home. And outside of the top 1%, of the vast majority of wealth for most Americans is in their homes, and that's $32.8 trillion. If you look at the current market, access to real estate-backed loans, paying them off takes capital and solid income stream, which is not always a reality for most Americans, especially when 40% of homes are owned by seniors on fixed incomes. Real estate prices continue to outstrip the pace of income, and interest rates will continue to rise. And that directly is impacting affordability for the majority of future homeowners. Real estate is still stuck in a bygone analog era, and you cannot access or leverage the equity in a property unless you borrow or sell 100% of the asset. Investors don't have any easy access to residential assets to build out a portfolio like they would stocks. And real estate is historically less volatile investment than stocks, but it's been subject to trade-offs like liquidity, diversification, and time management costs. So we've come up with a solution. We provide access to home equity without debt and loss of encumbrance of residential rights, affordability of financing and home purchases, this is for the homeowners, and investors a seamless investor connectivity to fractionalized and securitized real estate assets. The market we're dealing with is big. As I mentioned, over $38 trillion in total home equity, 2.53 in annualized home loans, and annual home sales are about $1.8 trillion. So imagine unleashing all that capital, giving homeowners the rights to leverage the value of their property to their advantage, access equity without debt to expand financial options, use that capital to pursue dreams, opportunities, investments, or deal with life's unexpected surprises, and manage the asset with online tools and market data. On the investor side, we're providing accessible, searchable residential investment marketplace. We're leveraging real-time market data and professional valuations. We're allowing them to build a portfolio of properties like they do stocks. And then we're leveraging liquidity options, and they can exit cash at will with simple wire transfers. How it works, we've created a point-and-click environment. It's all based on the Algorand platform. Owners actually come on, register, self-on board. They'd go through a DID, KYC, AML process. The property's professionally evaluated, ownership's verified, photographed, property's approved. The asset is tokenized, securitized, and listed. On the other end, investors go through the same process, KYC, AML process. They don't have to know anything about blockchain either. They can get their own Algorand wallet if they want to, or they can use ours. And everything happens on our marketplace. So a buy, sell option exists for homeowner and investor. Benchmark price is established, and they barter off and settle on a final price for the purchase of those assets. What it means is that as a homeowner, I could have retain 60% of my home and decide I want to go sell 40% to these investors. So $1.2 million home would break out that way. So if you're an older couple and you want to use this as an alternative to a reverse mortgage, you could do that. Alternatively, we could still partner with banks. So if you want to lower your cost of mortgage, increase the size of your down payment, we could work on a similar structure in that manner, and you could still end up having a mortgage of 50%. So what we have now in market is we've launched. We've actually got what we call our Tap into Home Equity product. It's an alternative for HELOCs, home loans, reverse mortgages, and selling. We are launching in August with our mortgage exit feature, which is going to allow people to buy out of their mortgage and be mortgageless, which obviously is going to be a popular feature of rising interest rates. We've talked to a lot of income property owners, and we're coming up with an income property and dividend solution that we're launching in October. And then in January, we'll have a loan-free home purchase feature as well, so you can buy a home with no debt. Right now, we've been in market for 2 months. We have 14 properties. We have tokenized equity of $7.1 million. That just went up today, actually. We had 2 more properties. I don't know the final amount. And we've accrued an investor database of over 10,000 investors. So what we're doing is we're creating a global fractionalized real estate market with the transactional tools, legal, regulatory framework for all real estate owners, property types, and investors to buy and sell in an online peer-to-peer solution, and the outcome of which will change how we leverage and invest in home equity while shifting the affordability paradigm and our present-day idea of home ownership. For more information, this is where you can reach us.
Awesome, thank you.
Fast.
Yeah.
So he answered your question back. So question is, we've looked at other companies like this that are using DAOs for managing the properties. How are you going to be managing the properties? If at all.
The owners retain the responsibility to manage the property because as part of our process, they retain all residential rights. So if you're a homeowner, you continue to live in the home, you continue to manage your home. We have systems and processes built in to make sure the home is maintained, et cetera, insurance is paid and stuff like that, and taxes are paid.
Yeah, I have a question. So, the homeowner, if they sell 50% of their property, are they paying 50% of the market rate to the rent to the owners, or is it like they just live rent-free on that 50% of the asset?
Well, what they're trading off in this case is they do live rent-free, right? They're selling 50% of that asset to those investors. So the investors are buying into the future appreciation of that asset.
So why would an investor buy that instead of buying a fraction of a share of a property producing income?
Again, good question, because appreciation on non-income properties tends to be greater than income properties. Plus, it will depend on someone's specific investment thesis. So if they, go ahead.
Well, I was just curious on that because I remember reading some research out of Yale that actually, homes are pretty bad investment. There's some interesting research that,
I'd love to see that research.
Yeah, I'll send it your way because, the actual appreciation of single-family homes that are primary residence isn't usually great.
Yeah. Well, that's the key risk.
I would disagree with that report, and I've got data backing that, saying that that's not true. So I'd love to see that.
Yeah, send it your way.
Yeah. So the key risk is that you're betting on appreciation of real estate as we're in this very frothy real estate environment.
Yeah, and I think it depends on people's investment thesis, right? If they want an income property and they want a dividend off an income property, we're going to have that for them as well. It's going to really depend on your investment thesis and what you're looking at short-term, long-term, how risk-averse you are or how risk-ready you are.
Awesome. Questions? Yes.
Yeah, they're insured. They're guaranteed, and we only allow them to sell up to 80% of the asset. So, yep.
Can you explain why this would be better financial model, better interest rates than the existing model? I mean, I understand the tokenization and the mechanics of it, but I don't understand why this would be better for the homeowner or the investor as compared to just doing a mortgage or doing anything that exists today.
It's cost. It's very expensive to have a mortgage. The effective compounding interest rate on an annual basis or on a lifetime of the mortgage is extremely expensive. So I gave you an example on a $344,000 home. You'd end up paying almost, I think it was $163,000 just in interest payments. So with our model, you won't have that. We charge a one-time 3.8% fee when the token is sold or the asset is sold. So there's a significant cost difference.
So why do you have to do it through blockchain?
We get to ask that question, why do you have to do it through blockchain? Because we're building something for the future, and to us it made sense to build this on a blockchain rather than not building on a blockchain. You could certainly try and do this not on a blockchain, but we felt that if you're going to build something, build it for the future, and it just made sense to scale. The transaction costs are significantly lower. If we'd not built this on the blockchain, it would have been very expensive. And there's the immutability of the transactions, which to us in something like this is extremely important.
How do you quantify the potential regulatory risk for something like this, given that you're building something for the future?
We've built this to be regulatory compliant, so we securitize everything. It's all done Reg D, and eventually we'll go Reg A.
Awesome. Thank you.
Thank you.
Thanks.